Hi, everybody. Thanks for taking the time to attend this webinar. Shall we start off by introducing ourselves ever so quickly? So, well, you probably know me from the videos. I presented the course. Oh, there's someone else. I presented the course. I'm a lecturer at the University of Delft, as you will have seen, and I do a lot of financings for renewable energy projects. I've seen in the chat that there are a lot of people also active in this field, trying to make the world a bit better and trying to fight climate change by putting together all sorts of renewable energy projects. Shall we just make a quick round and introduce ourselves? Miguel, do you want to kick off? Miguel Angel Lazo Santos.
Hi, good morning, everybody. I am Miguel. I am in Panama right now. And thank you very much for your very great course.
Thank you. Thank you. Glad you like it. Vladimir Golovin.
Hi, everybody. I am engineer from Russia. I'm starting from the engineering course of Delft and going to this finance course. It was a very interesting experience for me.
Fantastic. Good to have you on the course and good to have you here tonight. Özge Anoglu.
Hi, this is Özge. I'm from Turkey. I'm a civil engineer, and also thank you very much for the course and all the materials that we received. And it was a great pleasure. Thank you very much.
Okay, love you. Thank you. RF, Convidado.
Yeah. Hello, can you hear me? Yeah.
Yes, I can.
My name is Rui. I'm from Portugal. Okay, so I'm an engineer, physics, and well, I'm attending the webinar, but I'm quite in delay in the week, so I'm only on the third week. So I'll be just hearing. Okay.
Okay, that's not a problem. You have, I think, quite a few weeks to catch up.
Yeah, yeah. Something came up, so I'll have to use those weeks. I was not expecting, but I'll have to. So I'm glad with that. But I'll be just listening tonight.
Good luck with that. Thanks, Roy. Okay. Roberto Sersosimo.
Yeah. Hello, can you hear me?
Yeah. I can. Yeah. Hi there.
Yeah, I'm Roberto from Milan. I'm a wind energy engineer by formation. Been working in as a technical consultant for a few years, and now I moved into virtual power plants. So I wanted to deep dive into the topic, and I found the course very, very good. Thank you.
Thank you. Thanks a lot. Thank you for your compliment. And Richard?
Hi. My name is Richard Wesselman. I'm from the Netherlands. I have an electrotechnical background, studied in Delft, and I'm now for about 15 years working as project manager, and did the course because there is quite some overlap with the project that I'm doing at the moment. That also is quite a lot of similarity with also all the funding aspects that are in the course. So it was very fruitful.
Okay, well, thank you. Thanks a lot. The reason I designed this course is I have found that the language that technicians speak and the language that financiers and bankers speak is not the same, that they mean different things when they say things and they don't understand one another. And on the one hand, we have bankers saying we need more good projects to fund. And on the other hand, we have project people saying we need more money to be able to realize the projects that we're looking at. And I'm trying to bridge that gap by giving an appreciation. It's to the people who work in a technical role for what it is, how financiers think, what they look at, and what makes them decide whether or not to go ahead. So I'm glad to hear from all of you that you found the course materials interesting and that they serve your purpose. It's been a pleasure to put together the course, and I'm glad that it's helping you all. The purpose of the webinar today is to go through some questions that came in through the course in the fora. Let me share my screen with you so that you can look at this. Are you seeing now my screen, and are you seeing the questions as they came up?
Yeah.
Yeah.
Yep.
I can't always give people's full names because they sometimes use an alias, so I don't know who MRWWTT is.
This is me.
Oh, that's you? Okay. Yeah.
Yes, this is Vladimir.
Glad I
Thank you.
caught your question. So you asked more information about debt and equity and why debt is cheaper than equity. So let me show you just to illustrate that point, this graph here. This is a graph of the interest rates that the country of Russia was paying when it borrowed money from the markets in May last year and July and September last year. And this is the rates that Russia is having to pay now if it wants to borrow money in the financial markets. So you can see that rate
totally
has gone up
great.
from 7 to 13%. Why do we think that is?
I think that this is some politic reasons.
Yeah, it's the risk. It's the perceived risk that lenders see when they lend money to Russia, how big the chance is that Russia will be needing to default on its payments. So what this graph, I think, very well illustrates that there is a direct link between the risk of an investment and the return that an investment is expected to make. If you have a safe investment, you may be accepting. Let me just let some people into the lobby. Just 1 second. Is there anyone still stuck in the lobby? Let me see.
Don't worry, Emil. I'll take care of
Okay. Yeah. Okay. Yeah. So here we see that the bigger the risk, the bigger the return that people want. If we look at debt, the instrument of debt as distinct from the instrument of equity, in a debt, you are talking about borrowing money. When you borrow money, you have an obligation to pay that money back. And your ability to pay that money back and your ability to pay the interest is the decisive factor for how the risk for the lender is perceived. And in this example, we see that borrowing money as the state of Russia is considered to be more risky now, so they need to pay a higher level of return. When we have an equity investment, that essentially means that we are subscribing to usually shares in a company. So the company issues shares, you pay money over to the company, and you never have a right to repayment of that until the company is actually liquidated. So there's not a term that you give the money for, and there's no repayment obligation. Furthermore, when the company earns money, the first thing that it will have to do out of the net profits that it has at the end of the day is it will have to pay back its loans and the interest on those loans, because they have a priority over the equity in terms of the ranking. Loans have a higher ranking and therefore have a priority on repayments, and that gives them a lower risk. And because they have a lower risk, they also have a lower expected return. I gave some examples in one of the films of the relative returns between debt and equity. So the key answer to the question, why is debt cheaper than equity? The answer is because it's considered to be lower risk and therefore, it's considered to be, lower risk, and therefore it has a lower return. Does that answer your question?
I think that you answered my question. I forgot to say thank you for your course. This is first of all, but your answer is the same language that we get from from your course. And as you said at the start of this meeting of this webinar, there are different languages of engineers and financials, and I don't get clear. And my questions is about some examples. If you have some example of the equity debt and why the debt is cheaper than equity, it will be great.
Let me try and do that. Can you see me drawing now? Can you see what I draw now?
Yes.
So I see a company, and the company is going to make certain investments. In order to make those investments, it needs to attract money from other sources. And let's say that it issues, I'll explain what I mean by that. It issues equity and it issues debt. So it gets in dollars. Here it gets in, let's say it gets in dollars. Here it gets in dollars and it uses those dollars to make the investments. So and let's say that the investment is 100, and let's say that the annual return on the investment is 10. It has a return of 10%, and let's say that it it has to pay on the debt 6 in interest. Then it has 4 left to service the equity in this example. So the 10 comes in, 6 goes out here, and 4 goes to the equity provider. If instead of making 10 return, it makes a return of only 4 on the investment, it can still pay the 6. It can still pay a part of the interest, but it can't pay the return on the equity. The lender still wants his money back, so you'll need to get an extra 2 out of the return. You'll be eating up the return. That's how it works. So how would you raise equity? You would do that by issuing share capital. The company issues shares in return for a payment to the company. And how does it issue debt? Essentially by borrowing money. Does that address your question?
Yes, thanks. I think so. Thank you. I try to understand it, and the main reason is that debt will be same price. Probably. In any way, thank you.
Yeah, I would say if you were to borrow debt, essentially, are you understanding that raising debt essentially means borrowing money?
Yes, yeah. Of course.
And if you were to lend money to Germany, or you were to lend money to the Philippines, would you consider the risk to be different? The country of Germany and the country of the Philippines, which one would you rather lend money to?
I think it's more risky for lend it for Philippines.
For Philippines, that's so. Right. Yeah. So you consider the risk for Philippines to be higher, and that would essentially mean that for you to want to make money, lend money to the Philippines, you would rather have a higher interest rate than you would have. Yeah. Yeah. So that's really what's at play here, and the risk perspective is essentially what drives the return that people expect, and because equity has a higher risk than debt, essentially the required return is going to be higher.
I think it's clear. Thank you.
Thank you. Okay, thanks. So essentially summarizing, high risk is high return. A loan is safer than equity because it has a preferred rights to the cash flows. It has a repayment obligation, and often because it's secured, you keep collateral. You keep some kind of security that if the loan does not get repaid, you can take the house as security, or you can take a car or some kind of other asset that has a value that you can sell off to get your money back. So those, I think, are the main reasons why borrowings are safer. So then we had a question from Agatha. Agatha, in terms of risks, do lenders or investors share the risk by keeping it off the balance sheet? Agatha has an interesting question here on off-balance sheet treatment. What she means, let me draw a diagram again. So we have a company which makes investments. It's raised equity and it's borrowed money. Then it has a repayment obligation as a result of these borrowings. If it then establishes a company underneath, an SPV, and it borrows money in this company to make other investments, if something goes wrong with this company, if this company's investments go sour, because, I don't know, there's a fire, there's a big fire or something, and it cannot repay this loan, the key question is this entity, the one at the top, liable for repaying the loan that's down here? And there was a company, have you heard of Enron and the Enron problem? Has anyone heard of that? The Enron scandal in 2001. Enron was one of the largest power companies in the US of A. And it was a company that had, it was very successful. It had shares worth $90. And then suddenly they plummeted and the value of those shares plummeted to 26 cents. So they went really down the toilet. And the reason that Enron took such a beating is because it became clear that it had lots of obligations here, lots of borrowings here, that were not reflected in the accounts of this entity here. And that would have been fine, but then when these borrowings had to be written off, the lenders could go to Enron and collect money here. So it turned out that the company had double borrowings here, and it had not reported the borrowings down here in its accounts up here. And that was the reason why the investors lost all confidence in the company, and essentially the equity in the company went down to zero. So a lot of that is very similar to what we have described in the course in an SPV for project financing. Here also we have the SPV, it's borrowing money and it's making investments. And also there is a ring fence we saw around the project company, and its borrowings are not reflected in the top company. Nevertheless, there is not the same problem as the problem we had in Enron. And the main reason for that is because this whole financing is standalone. It's what they call non-recourse. That's another way for saying that the lenders to this company can only look inside the ring fence for repayment of their loan. They cannot go up here. They cannot collect any money up here. And in that case, it means that the top company is never responsible for or liable for the money that's been borrowed down in the SPV. And then off-balance sheet treatment, I think, is quite a normal thing to do. And what the accountants will want to make sure when they are auditing this company, they will want to make very sure that there are no obligations in this company for any repayments of the loans down here. Is that clear? So loans must be on balance sheet to show repayment obligations. If they're not on the balance sheet, they could hide obligations. If you hide obligations, that could give a misrepresentation of your accounts. I've given the example of Enron, where this happened and essentially led to the complete destruction of the company because it did so on a very large scale. In project financing, we have SPVs off balance sheet. So that could give rise to the same kind of challenges, but the accounting rules were tightened quite considerably after the Enron disaster in 2001. So now off-balance sheet treatment of loans is only possible if a financing is truly limited recourse, meaning that there's a very tight ring fence around the project and the project company, and the owner, the shareholder, is not in any way liable for the shortfalls of the of the project financing. Any questions about this?
Actually, I have a question, if you don't mind. I mean,
sure.
Here, I understand that, there is this fence, and so the main company is protected. But for the equity, sometimes, I mean, the lenders are asking like guarantees from the, let's say, the owner of the, or sponsors. And so that, they will put in the equity when the time comes, right?
Yeah, contingent equity, they call it sometimes. Conditional equity, you have to pay it maybe later if something goes wrong. Yeah.
And also I'm not a financial guy, so I'm asking, they're asking sometimes this letter of credits. So is it like some kind of a guarantee, bank guarantee?
It is, yeah, it is. Yeah.
Okay.
A letter of credit is essentially a letter from the bank, a bank guarantee that essentially says if something goes wrong, this company will owe money to these lenders. So as soon as you have an arrangement like you describe, whether it's contingent equity or conditional equity, or a bank guarantee, or a personal guarantee from the company, then you break this ring fence. Then the company cannot only look at the ring fence in the SPV, but it can also look at this company. And if that's the case, then you're exactly in the Enron situation that we were looking at before. It means that this company would have to reflect in its own accounts this liability that it has to the lenders.
But up to the equity amount that they have to put in?
Up to the guarantee amount. Yeah, up to the guarantee amount. Yeah.
Okay.
That's right.
Thank you.
You're welcome. Okay. Was that clear? Shall we move to the next question now? Tito? Tito, was confused about the concession agreement and the terms concession agreement and an offtake agreement. And he was confused by the fact that they are both covered in the same section. So let me do another drawing. Do you find these drawings helpful? So we have an SPV, a special purpose company, a project company that has been granted a concession by a government. For example, a concession to build a road and to operate a road. So the concession agreement does a couple of things. It gives the right to build the road, the rights to build. It has the right to operate the road. It has the right to transfer the road back to the government when the term is ended. And it has the right to either charge fees, that's called a toll, to the people who use the road, or it gets an availability payment, which is essentially a payment from the government. For every year of usage, the government will pay a certain amount of money. And that availability payment and the service charge, that's essentially the income, the dollars that are going to be earned by the SPV for making this investment. So to the extent that this element is in this concession agreement, it's essentially much like an offtake agreement in the sense that it serves as the guaranteed right to sell a product, in this case, to sell the usage of the road in return for a price, a payment, this payment. And therefore it serves the same purpose as a offtake agreement would do in a company, in a project where there is no concession. So the reason why we are dealing with the concession agreement and with the offtake agreement in the same section is because they serve the same purpose. Does that answer that question? Any more questions on that one? No? Shall we move forward?
I think we can. Thank you.
Yeah, we can. Okay. So the concession agreement grants the concession, but is also the basis for earning of the project. The offtake agreement is also the basis for earning. They're different contracts, but they largely overlap, and that's why we treat them together, in summary. So this is a question from Hylab. Is he on the call? Okay, no, okay. He's pointing out an important topic, the inefficiencies of a tendering process in a PPP. In a PPP, the government will ask all sorts of companies and syndicates to tender for building the project, and it will have to make a choice which one it's going to give the concession to, which one it's going to contract with. And he's pointing out that it's often an inefficient process because you choose someone, and he says you choose the wise guy, and the wise guy, they choose the projects, the partners and suppliers that end up not delivering on time or with not with the expected quality. They choose for their sales skills and not for their ability to deliver. And in the meantime, the potential better suppliers are kept out because they tend not to even participate in tenders for the risk of being outpriced and losing time in preparing proposals. Have you come across this yourselves? Have you seen that governments choose the wrong contractors? Okay, I don't hear anyone say yes, so maybe no one recognizes this problem, but it is an issue. It can be an issue because it would be, of course, if it happens the way it works here, that you're giving the rights to contract to the wrong organizations. There was a very good answer, I think, already in the forum from FICCO. He's pointing out, is he on the call, FICCO? Okay, I think he's giving a very clear answer. He already has experience with this, and essentially what he's saying is that if you are selecting a supplier, you need to have a process in place that is transparent and clear to everyone. You need to make it very clear beforehand on what basis you are selecting and how you are assessing the quality of the bids. You need to have a tendering committee in place that also embraces transparency and that there's no hidden information or that critical information is held back. So everyone needs to be clear what is expected from them and how they will be assessed. Often there's a ranking based on the number of points, so you need to make it clear what points you are allocating for what kind of services or for what kind of elements. You will need to engage early in the project development stage with partners, and work with them to understand how they expect to deliver on the project. So how will they be mitigating or hedging their risks, for example? If you understand how they plan to do that, you can make an assessment whether they're realistic, whether their plans are likely to succeed or not. And you need to apply rigorous risk management techniques to identify direct and indirect consequences along the way. And finally, you need to develop a bid, proposal and evaluation scheme and a process that allows this risk and its mitigations to be quantified, qualified and evaluated, allowing the score for that. I think this is already a pretty good summary of how you would avoid it. So you want to make sure that you understand who the bidders are, what they can do, how realistic they are to be able to deliver. And I would say one additional element that I consider to be very important is that the government entity that is organizing this bidding process needs to have the skills and the experience available to it to make all these, to design the bidding process, to make these assessments and to monitor what is going on. So you need to have not only knowledge and experience in the bidding syndicates, but also in the government that is giving the concession. And that is sometimes a problem because the government does not have that experience. If the government doesn't have that experience, can you think of a way how they could still get that knowledge and experience on their side? Anyone?
Just hire it?
Yeah, you hire it. You hire consultants. You hire specialist consultants from large firms with a lot of experience, like Pricewaterhouse or Ernst & Young, and essentially you pay them for designing the process and for monitoring the process, and the designing, making sure that the bids and evaluation and everything is transparent and professional. Yeah, I agree. And that you see that a lot, especially because governments often do not have that experience, that they rely on the services of experts to do this for them. Any other questions in relation to this? Shall we then move on to the next question?
I think, yeah.
Yeah. So Wilson Goodalow had a complicated question for me. Wilson, are you on the call? Okay. He is pointing out that there's a lot of digital development, digital analytics, artificial intelligence, machine learning, Internet of Things, blockchains, advanced cybersecurity and engineering. All sorts of smart brains are continuing designing and inventing all sorts of improvements in process, in assessment, in engineering. And he's asking whether project finance can be better assessed and better managed by using this, and that it can help to enhance the transparency with the stakeholders, and that it can help to make project finance more successful and more, better. Itzaya already gave a response to this. The thing that I find difficult, and I think this is one that is that I consider to be very important. I am a financial specialist, and I don't know anything about Internet of Things. I don't know anything about blockchain. I don't know anything about artificial intelligence. And asking a banker to make an assessment on one of these processes is like asking my grandmother to make that same assessment. It's not going to result in a sensible answer. So I think it's good not to overestimate the skills of a banker. Financiers are simple folk. They don't understand these potential technologies. What they will do if they get a question like this is they will call in specialists. So they will tell the company or the loan applicant, can you give me a technical due diligence? Can you make me do a survey for me where you answer these technical questions for me? And can you point out where the benefits and where the risks are? And then based on that advice that you give me as a technical DD due diligence party, based on that advice, I'll make a risk assessment. And based on that risk assessment, I'll decide whether to invest, lend you the money, and at what price. So it's a bit of a vague question, but that's because it's the concepts that this question is asking me about, Internet of Things, and it's just something that I don't know a lot about. Is anyone wishing to add to this? No? Shall we then move on? Oh yeah, well, I guess what I could say is if these technologies help to increase the predictability and reduce the risk, then reducing the risk is obviously good in terms of financing because it helps to reduce your funding rate and it helps to secure. Again, a question from Agatha. She's asking how you can get work experience or training. She says, like our instructor says somewhere in this course, one learns or knows project funding better while practicing. Is there any way we can get a recommendation letter to send to companies stating we need practice? In my homeland, I don't know where she is based, that is the only way one can learn further, through practice and get relevance in the industry. Something like a recommendation would be allowed to do industrial training for a short period of time to do more in this area. I really love it and meaning to practice and earn with one day. I'll be glad to get one. So I don't know where Agatha is based, so I don't know how it works in her country, but the way it works in the Netherlands, and I think in most of Europe, the universities in Europe tend to provide for or organize traineeships from companies, and the companies actually like to get a relationship with universities and like to get trainees in from the universities. It's a win-win situation because it gives work experience to the students. It gives them ability to practice in the field and see the knowledge that they build up in the university. Sometimes it's only a work experience, but sometimes often it's also used as a way to do a research. So you get a traineeship with a company to do some research, which you can then use for the thesis in your university. So in our countries, it tends to be an initiative that is taken up by the universities and by the companies looking for these universities. And they tend to have desks that are organizing this. For us in this course, it's not something we can do just for the students who are participating in this course. So I think Agatha would be well advised to just inquire from the university that she used to go to, or maybe is still going to, whether they have an ability to bridge this and give her a recommendation letter with companies that they know for a traineeship. Does anyone have any experience in this? Anything they would like to offer as well? No? Shall I move on then? A question from Bernard. Oops. Is the security or the collateral value of installations going to be enough to completely secure project loans? Is a question he asks. Let me draw this one again. So again, we have the project company. It's borrowing money. Let's say it's borrowing 100, and it's raising equity of 20, and it's making 120 worth of investments. And let's say that the investments are a wind park. So it's building, it's getting a location, it's building wind turbines, it's linking the wind turbines up to the grid, and that wind park is going to operate, and it's going to generate revenues from selling electricity, which is then used to repay the loans. And let's say that the lender says that in order to grant that loan, he needs to he wants to have a security over the shares of the SPV, meaning that if something goes wrong, he can take the project away. He has step-in rights. And let's say that he has a security on the power purchase agreement, which is the agreement that this company has to sell the electricity. And he has a security, a mortgage, a security on the land and on the turbines. So he has all sorts of different security rights. These security rights, in case something goes wrong, he can step in and he can exercise these rights. And the question then is, will the value of these rights be enough to repay? So the value of these rights, will they be enough to repay this loan? What are your thoughts? Does anyone want to venture their thoughts? Let's say that the problem arises because the demand for electricity is low because we have a big corona lockdown, and therefore you can't. There's a lower demand for electricity, so power prices have gone down. So this wind park, its profits have gone down because of lower electricity prices. So how would you then get value from these securities?
Hello, my name is Alejandro Funes from Tegucigalpa, Honduras.
Hi, Alejandro.
I was about to say that if you have enough, I mean, a good price in your PPA and you get the flows of money on time, maybe you have based your financial model on those revenues alone. But then you put this scenario here with lower electricity prices. That means that your cash flow is diminished. So you are in a big of a trouble, I think.
Yeah. Then your rights on this power purchase agreement will not have much value because the power purchase agreement is apparently, it doesn't give you the right prices. Maybe it's not got a guaranteed price or a minimum price. Similarly, if you have a guarantee over turbines, the second-hand value of turbines is probably not very high. If you have a security over the land, it may be difficult to sell a piece of land. So overall, I'd say the individual collateral rights are unlikely to be worth 100 in this example. So the whole point of a project financing is not really to rely on the value of these securities. In that sense, it's very different from other forms of financing, like a mortgage. In a mortgage, if you mortgage your house, there will be a demand for houses. It may be up and down with markets going up and down, but there's at least some kind of market for houses. For these kind of projects, it'll be there won't be a lot of demand. So that's why I think we are saying that one of the big elements of a project financing is that the value of the securities is almost always is lower than the value of the loan. And the only reason why project financing works is because you have, and I think just as Alejandro said, you're relying very heavily on the power purchase agreement. You're relying very heavily on the dollars coming in from selling the electricity. And one of the biggest things that a banker will assess is how strong is this agreement. It must have a minimum term, minimum prices, and a minimum volume to make sure that you never have to rely on these securities. Securities are only of secondary value. Any questions on this?
Yes, I have a question. Is there a chance that the agreement can be renegotiated?
Yeah, absolutely. Yeah, absolutely. You see that we see that now in the Netherlands. It's been a very interesting time that we've had in the beginning of 2020 and at the beginning of 2021. Electricity prices were really, really low because of the corona lockdown. And now with the gas crisis, the power prices have shot through the roof in the Netherlands. We've seen that the prices have gone through the roof. So there's a lot of what they call volatility, a lot of movement up or down in the market prices. And it means that sometimes you have to renegotiate these contracts. We have there's a region in the Netherlands where we have a lot of growing crops in greenhouses. The Westland it's called, where we have Holland is one of the largest exporter of cucumbers, tomatoes, all sorts of vegetables and plants. And they are grown in greenhouses because our climate is not very good for quick growth. And these greenhouses have to be heated with gas. And we were always fortunate in the Netherlands that we had a big section of the Netherlands has a lot of gas. But that gas has now had to come to an end because it's causing all sorts of problems like earthquakes. So that means that we have very little own supply of gas now, which means that the crop growers are in trouble. They have difficulty getting their financial models covered because they would have to pay nearly all their profits to gas prices, for example. Well, if you have a project that has an alternative for gas, like geothermal, do you know what geothermal is? Where you dig a hole in the ground in geothermal.
Yes, sir.
Yeah, you have two wells. You put water down into the earth, and you get water up from the earth, and it goes down at say 0 degrees, and it comes up at 70 degrees because there's a lot of heat down here. So this is a nice structure that can give heat to these growers of vegetables and plants. So the value of their product has gone up a lot because of the market prices, and they like to renegotiate the purchase agreements, the offtake agreements, to take into account the new market. So they like the prices to go up. Yeah, does that answer your question?
Yes. I imagine that agreement, you can always account for all the risks, but you can even just say that if something happens that is not predicted, there's space for negotiation between the parties, right?
Yes, indeed. Yeah, there will be in any contract, there will be what they call acts of God clauses. If there's something that happens that is not caused by any person or any human intervention, like an earthquake or a typhoon, in that case, the contract can be renegotiated. But you can also have renegotiations on commercial things. If something new happens that is unexpected, you can try and find a win-win situation between both contract parties. Yes, so contracts are, even in the West, to some extent dynamic. They can adjust with the circumstances.
Yes.
Even though you try and make the risks as low as possible, you can't completely eliminate them.
Okay.
Okay, sorry, go ahead.
No, it's okay for me.
Yeah, okay. I've gone through all the questions that I had. Does anyone have any other topics that they would like me to address?
Hi again, this is Özge.
Yeah.
I have a question, about your experience regarding the railway projects for infrastructure. And as far as I know, if you look at them, usually with the passenger tickets or freight revenues, it's really not easy, to fund the infrastructure projects. And so because of that, I understand that the governments mostly they step in and they put some guarantees or something. So if you can debate on this issue, I will be very happy.
Yeah, okay. When you are delivering products to the public that have a very large political or cultural importance, they become politically sensitive. If you look at water, water is very politically sensitive. Power is very politically sensitive. and public transport, being able to get to where you want to, is also very politically sensitive. So you can't leave that completely to the markets. You can see that if the market prices go double, people can't afford water, or they can't afford power, or they can't get to their work. That's going to be very politically sensitive. And for a project financing to work, you would need to be able to follow completely the markets. And if there is a political dimension, that makes it complicated for private parties, for banks and for private market parties to assess, because they have a risk on their books that they have no control over. And one of the basic principles of project finance is that the most efficient structure is that you put the risk with the stakeholder that has the biggest influence or the biggest ability to mitigate it. And the risk of say public transport prices, and how many people make use of the public transport, and whether a town is going to be successful or not successful, that's not something that a private company can have any influence over. So who do you think that risk could be brought to?
To the government or the Ministry of Transport.
Exactly. Yeah. And can you think
municipality
of a way,
or I don't
exactly. Yeah. And can you think of a way how you would achieve that?
To give a guarantee for the prices and the volume of the passengers.
Exactly. And essentially you call that in the book, it's called an availability contract. So essentially you have a fixed price for making it available, irrespective of the number of people that use it, whether they go up or down, or whether the prices go up or down. And that way it makes for a very predictable revenue stream, which means that it's a very attractive deal for lenders and investors, which means it can borrow at cheap prices, which then also means that the government has to pay a relatively low availability payment. So that's the most efficient way of dealing with that, I think. Yeah.
And what would be the preferred IRR for a infrastructure project that lenders look at? I know it depends on the country and the risk.
Yeah. I guess you could say that it depends on the sovereign risk. Are you familiar with the word sovereign risk?
Yeah. The government to government.
Yeah. The best structure you have, one which we just described, where you have a government guaranteed availability payment, that essentially means that you've got virtually sovereign risk, which means that the funding rates will be more or less the same as what the government would be borrowing itself at. It's never going to be completely that, but it's going to be close to that. Yeah.
Thank you.
You're welcome. Any other questions?
Hello. Hi, Roberto here.
Hi, Roberto.
I posted in the chat right now. Have you ever come across a project finance funding for virtual power plants? Because it's still a relatively new technology. And
for what kind of power plant? Sorry.
Virtual. So there will be utility scale batteries. There will be aggregation of EV charging infrastructure.
Yeah.
That kind of stuff.
Yeah. I'm actually working on one now. The Netherlands is relatively slow. I think there are. This is already a big thing in the UK and Germany, where they already have quite a lot of grid-related batteries. So there are attached to the grid, the electricity grid, there is storage capacity hooked up. And the big benefit of that is that with the increasing proportion of renewable energy from wind and from solar, of course, that's very volatile. And when people use electricity, say in the evening, and when the sun shines in the afternoon, they don't match up. So you have an unbalance in the grid, and battery parks can be a good way to level out that capacity. Those kind of projects can be set up as a project financing. What do you think, Roberto, would be important to get those projects successfully financed?
Well, the main risk is really about the future revenues, the future cash flow. And that was the why I asked the question, because the market, the regulation, everything is basically nascent. It's relatively new, and the TSOs and their DSOs are really like dipping their toes
into it. Yeah.
Yes.
The transactions, we've had 2 transactions in the Netherlands now, and in both those transactions, a local power company was an off-taker. So they signed a contract under which they agreed to use the battery for peak shaving and for a certain amount of peak shaving to level out the peaks in the grid, and for a certain amount of storage, where they agreed to pay a price. A proportion of that price is fixed, and a proportion of that price varies with the movement in markets. The fixed price component is a low risk because you've essentially got a large power company that is guaranteeing that amount of money. That tends to be funded by banks at relatively low rates. And then the variable upside, the potential upside that could be there or could be not there, that is more risky, and that's funded with a combination of equity and mezzanine loans or subordinated loans. Those loans have a higher risk profile because you haven't got a guaranteed offtake, but you do know that with the market, the way that the market is headed, with more and more volatility, the value of the balance is going to go up. And then we have what we call a commercial due diligence. We have a company that has a lot of experience and a lot of knowledge, and they essentially make an assessment of the potential of these variable returns. And then we build a base case where we say, based on the expected mid-level outcome, that needs to be at a debt service cover ratio of at least 1.3, which means you have 30 extra room, that if in 1 year it tends to be not as high as you would expect it to be, that you don't have an immediate financing difficulty. And on that basis, those transactions have successfully funded. So it does work that way. A way that it could be made more efficient and much more quickly is if the government would take over this risk, and if they would give some kind of a guarantee, but I've not seen that happen because it's just, I think, too big a risk for the government to bear. Does that answer your question, Roberto?
Yeah, thanks a lot. And just to build on that, does that mean only batteries, or also like EV charging station? Because that's a big topic, especially in the Netherlands.
And e-boilers. I think, so we have e-boilers, batteries, charging stations, all of that. There's a lot happening in the Netherlands at the moment in that field to try and, because our grid is essentially, it doesn't have the capacity to be able to absorb all the plans that we have. We have a very ambitious rollout of renewable energy, and we would never be able to succeed without these kinds of ideas. So there's a lot riding on that. How about in Italy? Is that the same in Italy?
It's building up. I'm working with a company that is operating mainly in France, Netherlands, and Austria. But in Italy, it's starting to, definitely.
Yeah, I'd say Austria has a wonderful, because they have hydro energy. I think that's probably something that they can use a lot as a kind of a natural battery anyway. They can juice up or juice down their turbines in water basins, can they not? Is that not a good solution, a cheap solution?
Yeah, that's definitely the best storage you have, right? It's just water.
Yeah. Exactly. Yeah, we in Holland we don't have many mountains. We don't have many possibilities for that, but that would be very cheap. Very good. Okay, thank you for your question, Roberto. Any other questions you would like to? Yep, I see a hand Not sure whose hand that is. Tristan? Hi, Tristan.
Hi, I guess I have a question and I joined the class late, so I'm still catching up and trying to follow some of the things that are being said. But I guess my question is more based on personal experience. So I'm in the Caribbean, and
Yep.
right now I'm working as a consultant within the UN system here in the Caribbean. And I guess my question is, how do we bring more investment to the Caribbean, who's known to struggle with financing? The government doesn't necessarily have the financing for our projects. I heard you mention a lot that some of the ways to finance the projects is to get the governments as opposed to the private sector. But in the Caribbean, that's a bit more difficult because we are smaller countries. And then in terms of even further than that, in projects where there are no real returns, for example, I work a lot in terms of health and agriculture and climate change. So I guess I was wondering if you had any ideas or any perspectives that you could share based on your experience.
Yeah, it's a difficult one because you indeed have a combination of a number of things that make it challenging. You have a small country is always more difficult because you need the potential of a large country. A country like the Philippines is also a country of islands, but at least together they have more clout. Together they are a large company. So if you want to build a large project for, I don't know, for a power plant or for roads, or you need to have enough demand for the product to be able to cover the investment. And if you have countries that are relatively small, and if you have countries that are relatively poor, meaning that the ability to pay for the product is low, that's a particularly challenging circumstances. I'm hoping that for you, maybe exploiting the sun. I don't know. Is that something that you've thought about? Solar energy, hydrogen, using solar panels to generate hydrogen as a cheap form, and I think an energy source that is growing a lot. Do you see that happening?
Yeah, I see the move to more solar panels and governments offering, if you install a solar panel on your roof, you may, you can use that as opposed to the electricity grid and stuff like that.
Yeah.
I guess I haven't necessarily figured out a way to market that to investors for other projects. I mean, I'm sure it would be possible, but I guess I haven't really thought of how it could work. I don't know, maybe you can elaborate a bit further.
But for me, a good example of how it could work is Singapore. Singapore is also a relatively small island. It's probably still larger than Barbados. You're in Barbados, right?
Yes, please.
Yeah. How many inhabitants in Barbados?
About 280,000.
Okay, so that's quite a bit smaller than Singapore is 3.5 million, I think. But in Singapore, they've been very successful in exploiting their position near the equator. They have, for example, they have solar installations, solar-powered installations to make drinkable water out of seawater, which is apparently a process that is very energy. It requires a lot of energy, and drinking water was difficult to was a problem. They were always reliant on their neighbor country, Malaysia, but then they made a large investment to have a desalination plant on solar energy, and that's a project that would have easily earned back its money because drinking water was very expensive in Singapore because of the scarcity. But if you have 280,000 people, that's obviously Yeah, that's not a very big market. I've no idea how big such an investment would be, but it would be a wonderful way to make yourself independent for at least an important commodity like water. Not sure I can help you much more with that, Tristan.
Yeah, no problem. Thanks.
Okay, I think we're reaching the end of what I had in mind. Any last questions you'd like to raise?
Probably you could add a few words about the brownfield projects. As engineer, I worked with a big company from other countries. For example, it's Cargill, Mondelez, and it's look like they have only equity. Don't ask any investors for the building of the new plant and this theme is not opened for me in the course, and probably you could add few words about how it worked for the big companies, because I see that they don't try to find any investors, only decide by themselves what they want to invest and what the project they want to lead in the companies.
Yeah, and what do you mean by a brownfield project?
For example, we have Cargill at the previous years make big project in the Krefeld that modernize, update the big plant from the scratch to the another product production, and it's look like the big project, big quantity of the investments for this project, but I don't clear understand do they make the do they borrow the money, do investments, do they have only equity or something else?
Yeah. Okay, well, what one let me think how I answer this. In the video that deals with the difference between corporate financing and project financing, I show the example where if a company like Cargill wanted to undertake a project, let me share my screen again, and let me do a new drawing. So we have Cargill. It could undertake a project itself, and then it could fund that project with its own resources, or it could undertake that project through a special purpose vehicle, and it could fund it at this level. The funding could be here, or the funding could be here. And your question is, which one do they do? Right. That's
yes,
at least what's one.
Yes. I want to understand. And in the big risk country like my, it's look like they only don't use SPV. It's look like this, but probably you know better, because I'm an engineer. I only see from my side the big companies that already have the money.
Yeah, I understand. I think I don't know firsthand because I haven't been active in Russia, but what I do know is that for a structure like this to work, for a ring-fenced structure like this to work, you need to have a very reliable and a very predictable source of revenue.
Could I interrupt you? SPV in this case, it means that they will create the company like something like Cargill Russia. Cargill rules on something else.
Yeah,
it
exactly.
will be SPV in this case. Okay, thank you.
Yeah, and if they do that, they need to, and they say to people who lend money to this entity, they need to say, you have to rely entirely on the income that comes in here, and nothing else. Then it means that they will need to have very strong contracts and very strong contracting parties at this level to make secure income streams. And probably they're finding that the people wanting to make this funding are not satisfied with just only the risk here. They want to have a guarantee from Cargill. That's the same question that the gentleman from Turkey asked. So if they have a guarantee from Cargill, it essentially means that it's like funding here. As soon as you have a guarantee at this level, it means that it's like your own funding. And Cargill has lots of activities inside Russia, outside Russia. It's a big company with a big financial profile. This company has a very small profile. So that's probably why they're probably cheaper off funding it here than funding it here. And that may be one of the reasons why they do that. Another reason why they do that is they may value their independence. As soon as you have a structure like a project financing, you will have seen that there's lots of rights that the lenders want to have on stepping in, ability to step in if there's a problem, voting rights on certain aspects of the project. And maybe Cargill says, we know how to do business, we'll do it ourselves. We don't need a banker to tell us how to do it. So we'll just do it at this level. And then they don't have the same step-in rights and the same problems. That may be a reason why they prefer to do it at corporate level. Okay.
Okay. Okay. Thank you.
Thank you. Okay, then I would like to round off. Thank you all for joining us. For me tonight, for you tomorrow, today, wherever you are in the world. It's been a great pleasure to make your acquaintance. It's been a pleasure to get your questions and to answer. And glad the people who said they liked the course, I'm really glad you like the course. I hope it helps you achieve your objectives, and it helps you to make it clearer how to succeed in financing. Thanks all for your time, and have a good day, and maybe see or speak to each other again some other time.
Thank you.
Thank you.
Thank you.
Thank you.
Bye.
Bye, everybody.
Bye bye.
Thank you. Thank you very much.
Cheers.
Bye bye.
Bye.
Thank you. Bye-bye.